The job market has taken a massive hit, leaving 550,000 Americans unemployed. What's coming next will shock the nation. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, while most Americans are preparing for an economic boom under President-elect Trump's second term, a startling new survey reveals accelerating job cuts as more manufacturers are shedding workers at a faster pace, which is now leaving many wondering, is a recession next? Let's over to Bloomberg, where we picked today's story up with the headline as U.S. manufacturing measure edged higher at the end of the last year. So I want you to see how the media is spinning this, because based on the headline alone, you would think, well, things are getting better. Well, that's not exactly the case. As we look underneath here, we see the December factory index rises nearly a point to 49.3. Now, if you're not familiar with how these ISM surveys are done, anything under 50 is a contraction. So what we're actually seeing is the manufacturing sector continue to contract, just at a slower pace than it has last month. And this is giving, of course, the media some room to actually tell people that things are great. But when we start to look at the labor market and what manufacturers are actually doing, what we find out is the U.S. economy could be squarely headed into a recession. The group's measure of new orders rose more than 2 points to 52.5, the strongest reading since the start of last year and matching the highest since May of 2022. And this is the good news of the report. We see growth in new orders, as this is exactly what you want to see when you're talking about a soft landing or perhaps even green shoots showing up in the economy. You want to see demand at the factory level in the form of new orders. But there's a big problem with this, is that there isn't enough new orders. And based on what we're seeing, we're actually likely to see a big decline in new orders next year. I'm going to make the case of why. What we're seeing here is a lot of optimism post-election and having to do with holiday seasonal restocking. The pickup in demand helped generate the first month of expanding production since May based on the output gauge. And for the labor market, this should be fantastic news, because when you hear production is rising, well, that means manufacturers need more workers. The problem is the data is suggesting the exact opposite and has nothing to do with new orders. We've been warning this would happen. We'll show you, but let's take a look at some charts first, because what we see, and when we compare new orders to utilization, we're first looking at manufacturers' new orders of durable goods, this shown in blue, against capacity utilization, and this shown in red, both on a year-over-year rate of change. And just as we would expect to see, as demand for new orders declines, what happens is utilization of a factory goes right along with it. What we're seeing, at least from the government level, is a contraction in new orders. What we're hearing from the ISM is a small rise in new orders, at least that over last month. But will this last? Well, the odds are it's not going to last, because what's coming to the U.S. economy is going to outright shock the nation. Because let's take a look at the relationship between capacity utilization and the unemployment rate. You see unemployment rate in blue against the capacity utilization rate in red. That's shown as a percentage of a factory that's being utilized. And what you see here is a near mirror relationship between the two. And it makes perfect sense. As demand shows up at the factory level in terms of new production and new orders, what happens? They need bodies to help produce all of these goods. Hiring goes up, unemployment rate goes down. But when demand goes away, what happens? They start to lay off, and in a big way, because there's no need for excess employees, because for a manufacturer, paying people to stay around is a great way to go out of business. And what we can see recently in the data is that the unemployment rate has been rising, matching a decrease in capacity utilization. When we go back in history and we look at these gray shaded bars, what we see is this is the exact relationship that shows up heading into each and every recession, and that is a decline in demand in terms of utilization against rising unemployment, indicating that there aren't enough jobs for all the people who want one, and that's dangerous for the economy. At the same time, the survey revealed more producers reduce staffing levels at a faster rate. So what I want you to see is why the media focused on the fact that they see the manufacturing sector getting better, meaning it's only contracting at a slower rate, and that new orders were growing. What they're missing is what's really happening in the labor market, and that is more Americans are hitting the unemployment line, as we now start to see a case where there is less demand for workers than there are available workers. And this is a huge issue, because as people hit the unemployment unemployment line, their incomes go down, their spending goes down, and that affects the incomes of other workers who are then going to face further job cuts and hours getting cut, meaning their spending power is going to drop. And what we're going to see at a time when Americans are really betting big, at least what we see in the equity markets, that we're going to see a massive bull market in stocks fueled by a strong economy. What we're really seeing is the beginning stages of the U.S. labor market coming unwound in a big way. The employment index for the ISM fell almost 3 points, the most since July, to a solid contractionary 45.3 in December. The rest of the 5 measures that make up the overall purchasing managers gate all improve. And something that should be improving, that is your trading account, because if you're looking to make money, we're batting 1,000. Check this out. This is as of close of business yesterday. We have 3 open trades with our CTA Timer Pro subscription. 2 of the trades are beating the market. You can see this. This is all from 2 of the trades are beating the market. It's just that simple, my friends. Each and every day we look at machine positioning and the markets, and we look for discrepancies in how the markets are moving versus where the machines are at. And when we find that the machines are in deep short positions and markets moving against them, what it means is the machines have to come in and buy. It puts big buying behind you, which is why we love this report. You get this report, you get all the tradable signals, and I review all of them to give you my opinion on which one you should take. We backtested our reports to validate it's how successful it is. We give you risk control levels. We keep track of all our open trades, and we give you a weekly update. Not to mention, I trade my own reports. You want to know exactly what I'm trading and why? You can find out. You can trade right alongside me. You can buy before I do, sell before I do. You can follow along, and you still get that 30-day free trial. Many reached out and said, Steve, I'm on vacation. Can you hang tight till I get back, extend the trial? You got it. Links in the description below. Grab it before it's gone, because something that's going away is demand for U.S. goods and services along with U.S. labor. Although they note that demand improved, production execution met November's performance, but destaffing continued. But here you see from the chair of the ISM Business Survey Committee, what did he say? That the destaffing should end soon, but it's not going to end soon. And that is what's going to shock the nation, as many people believe this is just a soft patch before President-elect Trump takes the helm of the economy and turns things around. But what we're seeing here is the economy is greater than one man. What we're finding out is we are in a globally synchronized economy. What's happening in Asia and Europe is affecting U.S. employers in a big way. And one of those ways, what's driving the fact that even though we're seeing an increase in new orders, why are manufacturers shedding jobs? Well, we've made this case before. We said this was going to happen. Has everything to do with backlogs. And what we can see now for 27 straight months, it's over 2 years, backlogs have been contracting. Now, they contracted at a slightly slower rate than last month, possibly due to the increase in new orders. But what you can see here at 45.9, what this means is any backlogs, they're eating away through them. And so what happens as the backlogs go away and you don't have enough new orders to sustain your workforce, you start cutting hours and you start cutting heads. And that's exactly what we're seeing here from the ISM survey. They're saying, look, we don't have enough work for all the people that want to work. We have to get rid of them. And that's a problem, because their spending power goes down, and that's going to have a reverberating effect all through the economy. It's going to be felt from businesses all over the country. And this is a major problem, because what's going to shock the nation is the unemployment rate's about to scream higher. When we take a look at manufacturers' new orders, this is the lifeblood of the economy, because when consumers have money and they feel good, they go out and spend. They borrow money they don't have to buy things they don't need. And what do we see? As new orders go down, which is what we're seeing from the headline government data, you can see that in blue. Clearly, the unemployment rate goes up because the economy does not need people to produce things that cannot move off of shelves. And you see it very clearly going into each and every recession. When you get a slowdown in new order growth that's matching a rise in unemployment, there's nothing that can stop what's coming. and that is a recession, something that most Americans aren't expecting and would be a complete shock at this time. And producers are also contending with elevated costs as the ISM's gauge of prices paid rose by 2.2 points to 52.5. So what we're seeing now is inflation continuing to build at the factory level at a time when people are losing their jobs. So you think about it, if people are losing their jobs, what does it mean? Their spending power goes down. If prices go up, that means what money they do have doesn't go as far. It's setting us up for a much larger recession, something on the level of a financial crisis, because this is exactly what we see in the data. Let's take a look at real retail sales shown in blue, that on a year-over-year rate of change against the consumer price index, that in red also on a year-over-year rate of change. And we can see going into the dot-com bubble very, very clearly, we saw that prices were rising. We see consumer prices in red headed up. They kind of plateaued on their growth rate. At the same time, inflation adjusted retail sales were declining. Prices were too high. Consumers could not afford them, and next thing you know, you go right into a recession. But what happened going into the financial crisis is inflation surged due to rising energy costs, and that meant a giant plunge in retail sales, put us right in the midst of a financial crisis, because consumers found themselves with less and less money, and next thing you know, goods piled up on shelves and the whole economy fell apart. We fast forward to 2022. What do we see at the beginning of 3 years of negative real retail sales against declining inflation? But if we do see an uptick here, it could be very damaging to retailers. But the ISM survey, they didn't believe that. The media doesn't think that's what's going to happen. They think everything's going to turn around. But let's take a look at some of the notes that came in. It said significant slowdown in production requirements in the last 2 months of the year, not the sign of a recovery. Order levels well below forecast projections. Well, there's definitely an uptick this month, though not a stable one. And orders have increased slightly due to seasonal restocking. Of course, the question comes, what happens when seasonal restocking is over? Well, some believe that there's going to be a huge amount of demand for the economy. I'm going to make a case of why that's not going to happen. Meanwhile, inventory levels at manufacturers and their customers continue to contract. So what we're seeing now is that what we're seeing is inventory levels going down, and this is actually a good thing. Now, the issue is people are going to say, well, declining inventories means people are going to order. And sure enough, that was a conclusion. The ISM measure of customer stockpile shrank at the fastest pace since July, suggesting there's room for orders to remain firm in the coming months. But when you look at the actual data, when we look at inventory levels, we don't get that perspective at all. In fact, we get the exact opposite, that inventory levels are too high, and there's a reason why we're seeing retailers and wholesalers not turn around and order here, because they don't need more inventory. They want to clear out the inventory, bring it down to levels that match supply. They're only buying things that they need, perhaps seasonal things or things they're selling out of. Because check this out, when we look at retailer inventories, this shown in red, this is in terms of millions of dollars against real retail sales. What I want you to see is that inventory levels start to flatten out. Now, it's hard to see here because the retail sales data is overlaying against that, but look at what happens going into the global financial crisis. You see a slowdown in real retail sales. At the same time, you see rising inventory levels, and next thing you know, they plateau and they come down. Again, what you're seeing here is retailers trying to bring their inventory levels in line with demand, and you need to do that because it creates pricing pressure, it creates pricing power. And if you're a retailer, you've got a lot of fixed costs in your businesses, which most people do, you need to keep prices at a certain level to meet your expenses. And that's exactly what they're trying to do here. We see that happen again around 2019, where inventory levels flattened out. But look at what's happened over the past 3 years. Inventory levels are rising. This is a huge problem. They're not coming down as we would traditionally see going into recession. Because something I want you to think about, let's say you're going out to buy a new car and you go to a dealership and you don't see a lot of people out shopping for cars, but the car you want, let's say there's 30 of them on the lot. Now, what are you thinking? The dealer's going to want to sell some of these and they're going to give you a deal. But what happens if you go look for a car and there's only 3 of them on the lot that fit what you're looking for, and someone's standing there looking at them? You're not thinking you're going to get a deal at all. And that's exactly what retailers are thinking as well. They need to clear their inventory down because consumers are going to expect that they're going to get a discount, and that's right. And we see that now. People want a discount, but if supply goes down to match demand, all that view is going to go away. And when we take a look at inflation-adjusted inventory levels, we see the same picture. Now let's put that on a year-over-year rate of change. We're keeping that in red. And what do we see as real retail sales decline as we look here in the mid-90s? What happens? You see an equivalent deceleration in retailer inventories. You see that happen again going into the dot-com bubble, the global financial crisis. You see it very clearly. But look what happened around 2022. Retail sales went negative for 3 years. We see retailer inventory growth slow down, and then about 2 years ago, it shot up. And this is a problem because many believed if you stock it, people will come buy it, but that didn't happen, meaning they've got to pare down their inventories, and in a big way, meaning from the manufacturing perspective, they realize what's coming. Yes, there's been some growth in new orders, but as these backlogs go away, what's going to shock the nation is Americans are going to hit the unemployment line. And what we recently saw from 550,000 Americans lose their jobs, well, it's going to get a whole lot worse. Because in a chilling warning sign, unemployment claims are rising again, and this is breaking historical norms. Is this the start of a deeper economic crisis? Well, you're not going to believe it, but it looks like it. U.S. initial jobless claims fall to an 8-month low in 2024, and they still remain near historical low levels. Well, at least when you look at the seasonally adjusted numbers. New claims fell by 9,000 to 211,000. Meanwhile, continuing applications, a proxy for the number of people receiving benefits, also fell to a 3-month low of 1.84 million in the week ending December 21st. So what do we know? That in the middle of the month, as things were of the economy were right in the heart of the holiday season, we did see people lose their job, but they found some jobs right away. But isn't going to last? Well, based on what we're seeing in the manufacturing sector, not at all. Let's take a look at the non-seasonally adjusted numbers because they paint an entirely different picture. Here you can see in the week ending December 21st and 28th on a non-seasonally adjusted basis, 550,000 Americans lost their job. The 283,000 that were lost at the week ending December 28th paints an entirely different picture than the seasonally adjusted 211,000. The only good news is continued claims did drop. 76,000 was on a non-seasonally adjusted basis. But the current levels for the initial claims are subdued. So I want you to see the media's perspective here, which is in line with their pre-pandemic levels and consistent with a job market where companies are generally holding on to their workers. But that's in complete opposition to what we saw from ISM. And so on Thursday, you see the media saying, look, labor market's fairly stable here, demand's good. And the ISM survey comes out and says, wait a minute, no, we're shedding workers here and at a faster pace. And after 27 months of backlogs, we can start to conclude that the backlogs are almost worked out. And that means going into next year, we're going to see a huge rise in unemployment. In fact, when we look at the unemployment rate in red against continued claims in blue, this is a little bit of chart crime, my friends, because the two are not related. They're not using the same data source, but I want you to see that when continued claims are rising and the unemployment rate is rising at the same time, what do you see? A gray shaded bar shows up each and every time. That means a recession on the horizon if we continue to see the two tick higher. And despite the drop in continuing claims, recurring applications for U.S. unemployment benefits are set to post a second straight year of increases, which is historically rare outside of recessions and reflects the cooling in hiring. So despite the media's portrayal that the labor market's stable and manufacturing is growing, what we're seeing is the labor market is something that indicates we're headed squarely into a recession. And over the past 50 years, back-to-back annual gains in continuing claims have only occurred during recessions and times of massive layoffs. The past couple of years, we've seen something different, but that's about to change because what's going to shock this nation in 2025 isn't that we're going to see a big turnaround in the economy, as that we're likely facing mass unemployment and a recession. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.